All right, let's start with the first lecture of today, which is about scenario generation. Before getting into different scenario generation methods, let's start with an introduction to what is a scenario and what is the difference between scenario generation and forecasting. So a scenario is a synthetic description of an event or series of actions and events. So essentially what does that mean is that scenarios, of course, is something that has not occurred yet, but it's our way of trying to look into the future and not say exactly what's going to happen, but going to look into some different alternatives of what might happen. So that process is called scenario generation. And there is an important distinction that you need to think of immediately when you think of scenario generation, is that scenario generation is different from forecasting. But then again, understanding forecasting kind of helps you understand scenario generation. Because when you think of forecasting, maybe somebody can tell me what is forecasting. Because that's pretty straightforward. You've done probably some forecasting already. You had maybe a course on that here on campus. What is forecasting? It's like weather forecasting. That's a good example. Yeah. Predict the future, right? So when you say that, when you talk about weather forecasting, normally what you think of is that you say, well, tomorrow the temperature is going to be, I don't know, 5 degrees, right? So that's a very precise number. Of course, there is some uncertainty around that, but when you think of forecasting, it's about, actually, as you said, it's about predicting the future. Could be something like the direction of the wind, or even how strong the wind is going to blow tomorrow, or the next few hours for that matter. So there are particular stochastic variables. There are particular uncertain events that you can use into kind of some sort of crystal ball models, if you like, and based on different kinds of parameters which are having an impact on the outcome, you can pretty precisely predict what the outcome of that event is going to be within maybe the next few hours or within the next few days. In some cases, might be even in some months. But so that's about forecasting, and there is a lot of energy going into forecasting, of course, because, well, that has got a lot of value in terms of weather forecasting. Of course, if you can predict that there is going to be heavy rain, for example, then of course that could be extremely valuable to businesses or to farmers, and in many aspects, or if you know that the weather is going to be stormy, then it's very important information in order to not to go out sailing, or to be maybe evacuating an area if you know that a tornado is going to hit your town, right? So predicting is extremely valuable, and it's about ahead of time predicting exactly what's going to happen. Well, there are then a series of uncertain events for which prediction is not really a possibility, but scenario generation can be. So the cases where you cannot predict the future, you cannot, with more or less some degree of certainty, say what the future is going to bring about, then still it might make sense to try to look into a crystal ball. You wouldn't be able to predict the future, but you will be able to predict some different scenarios for the future. So that's what we're talking about today. That's the idea behind scenario generation. So what could a good example of that be in the context of this course? Well, political environment, but then, I mean, in some cases, even political environment, I think probably I'll save it for what I will call in a bit chaotic. Even, scenario generation might not even be possible in some cases, but something simpler.
I mean, like that could lead to like higher and lower taxes, for example.
Yeah, but then again, that is something that it could be even difficult to something simpler than that. So let's start. We get back to that, but something that what we have already been working with. Interest rates. Yeah, that's a good example. Another example where it makes sense to generate scenarios. or stock markets, right? So the prices of financial instruments, prices of stocks, right? So if I want to turn it back and say, well, can we predict? Are there models out there? I mean, you might have not been studying it, but can you, if you want to guess, do you think you can find some models which reasonably well can predict price of stocks in the future? You think that there are?
No, they're not perfect, but they can
They can
get some predictions.
get some prediction, but are there kind of models that in general broadly acceptable and broadly used by many people? No, that's the thing. Why not? Why would you not think that it's predicting, even though you're right? I mean, there are people who are trying to predict interest rates and trying to predict stock prices, but with very little success. Sometimes with some degree of success, and sometimes they can set up strategies in which they can actually make some money. But we don't have models which are as resilient as, let's say, models which are predicting the temperature or you know how the wind is going to be blowing, physical uncertain parameters. So why is the reason? Why would you think that it's not possible to predict how the interest rates are going to develop for the next, let's say, few months, or how the stock prices are going to develop for the next few months? It would have been lovely if it was possible, right? If you could predict it somehow, but
Because it's hard to predict human behavior.
yeah, well, but I mean, there's something more fundamental than that. But I mean, that is true. It's difficult to, the human behavior is definitely difficult to predict, but there's something more fundamental than that. Yeah, I mean, and that's also true. There are many variables which put into this, but again, even if we want to get into something even more simple and, you know, but more fundamental.
The price is responding to an offer and demand in the market, and that's extremely difficult to model.
Yes, so you're getting there. So I would say, yeah, maybe.
When you predict the future, can predict the future is changing.
That is almost there, right? So exactly by trying to, if you had such a model, trying to think it, the logically, if you were able to have a model which was, let's say I came to you and say I have this model, this crystal ball model, which can tell you how the price of a stock is going to go, and everybody would use it, right? So you wouldn't be here for a minute, right, until you use the model, and maybe get some money out of it, but then that model is useless, right? Because again, what you said was that the prices of financial markets, our actions, you know, how much we buy and sell, are having an impact on the prices, right? So contrary to the direction of wind, I mean, wind couldn't care less if we wanted to, blow west or east, right? Wind would blow the way wind wants to blow, right? So there are many factors which put into that, but our interaction, our trying to guess what direction wind is going to blow has no impact on the direction of the blowing of the wind, right? But our predictions in terms of how the interest rates are going to go up or down, or the prices of stocks are going to go up and down, if we are going to act to those predictions, is going to have an impact on the prices of the stocks and bonds. And that very dynamic, that means essentially that it is fundamentally not possible to come up with a reasonably good model for predicting prices of stocks and bonds. You understand that distinction? So it is, and it's so there are many people who are. I mean, what you said was right. There are so many parameters which go into that. It's difficult to come up with such models. But in a way, I would say, why even kind of bother? I mean, of course, then I can get back, and there are some certain cases why some people would bother, and there is, in very small periods of time, you can go in and make some prediction, actually make a lot of money out of that, and some people actually are trying that. But by and large, if you are considering financial markets in their entirety worldwide, then it doesn't really make sense to try to come up with a crystal ball model which is going to predict the direction of what the prices of the stocks or bonds going to be, because, well, I mean, by construction, your model is going to fail. I mean, even though you make the perfect model, a second later, that model would not be perfect anymore, right? So that's the thing. what you normally see also, there have been actually done a lot of studies where people try to analyze the predictive models, let's say, on interest rates. And what happens is quite interesting. Almost always when you see these studies, that they say that those who are trying to predict, those models which are trying to predict the direction of interest rates, because there are actually models who are trying to do that, and they have theoretical interest. And those models are almost in all cases, in the long run, they are about 50% right, 50% of the time right. What does that tell you? That they are exactly 50% of the time right. They're useless, right? Because if they were, if I would prefer them to be right 10% of the time, right? So, because then I would just do the opposite of what the model said, right? And could make money out of it. So by the nature that they are 50% of the time right and 50% of the time wrong, and it's not in terms of just the direction. So if you're trying to guess the direction of interest rates, up or down, it would be valuable if you had a model which could tell you the direction of the interest rates for the next month is going to be up or down. And there are actually models who are trying to do that. But then if you test them, you will find out that they are only true in the long run, only 50% of the time. So if you just use them repeatedly, in the long run, you're actually, you could just as well forget about using them, right? So that's, sorry? Then you could just as well guess, right? So if if you just do a coin toss, right? So that would be exactly the same effect of using those models. Yeah. Right. So I hope that kind of clears out. There is a you know what at least prediction is, and then predicting financial returns and in things like interest rates and the prices of stocks are not predictable. By and large, they're not predictable. But it makes very good sense still to generate scenarios for that. And we do that not in order to find out what is the average of these scenarios, because in many cases, essentially the models you will be using for prediction, they could also be used for scenario generation, right? But the way you use them is different. So normally what you do in prediction models, that you will use the average estimates of what's going to happen to happen in the future. You're actually using that average as the prediction of the future. When you do scenario generation, the average is kind of useless, because if you are averaging out all your scenarios, then that would kind of predict what's going to happen in the future. And I just argued that it's not possible to predict the direction of interest rates or the prices of bonds and the stocks, right? So since that is the case, then if I have a number of scenarios and if I average them out and just use that as a proxy for the prediction of the future, then kind of I'm cheating myself still. So I can generate scenarios, but I have to use the scenarios not for guessing the average of what's going to happen, not to predict the future, but in order to do risk management. So like what you did last week was that very simply look into the historical returns of the last, let's say, 154 months that you looked at. And then we say, well, I mean, we are not actually even trying really to predict the future. We are coming with very, very crude, simple scenario generation method where we're just saying, well, next month, we guess that what's going to happen next month is going to look like what happened in one of the last 154 months. Essentially, that was the effect of the scenario generation we did last week. Just repeating the last 154 weeks and generated 154 scenarios, using them as 154 scenarios 1 month ahead. If you average them out, that would be just the average of the last 154 months, right? So if you were using the average of that in order to find out what you have to buy, then that would amount to having a prediction model, which is predicting the return of next month is the average of the last 154 months. And you would probably not really believe in that, right? So if I said that the average of next month is always going to be equal to the average of the last 154 months, then you say, why would you think so? Yes, I don't know. But then if I told you what is going to happen next month is probably going to be some sort of a variation somewhere in the interval of what happened in the last 154 months, then you would say, well, maybe that sounds more reasonable, right? So that's the value of scenario generation in terms of risk management, and not so much in terms of finding out what's going to happen in the future, but in trying to contain many different possibilities. Still, there could be things happening in the next month which were not seen in the last 154 months. That's why we have to do, and we can do more with scenario generation, and that's what we are going to look at a little bit today. And I'm going to send you some pointers that you can look at and work with later on. Right. So the process of scenario generation always starts with some data. Many times, almost all the time, say you will start with some historical data. So if you didn't have historical data, and that brings us maybe back to the case of, let's say, things like you said, historical political events and what have you. What's going to happen, politically, let's say within the next 6 months or 1 year in the U.S., right? That is even really difficult to say, because how do you gather even some data from the past which resemble, I mean, you might be able to in one or other way, right? But in many cases, it's really difficult to reasonably well for some events like that, like political events, to actually even have historical data. So those events might not even be, it might not even be possible for you to look into scenario generation. But the methods, when we are talking with kinds of uncertainties, like the direction of interest rates or the prices of bonds and stocks, then we have very good historical data on that. Like we have years and years of data, so we have an idea of how these different markets, kind of interact with each other over time. We have an idea of the prices, how do we go up and down. This is a relatively simple thing which we are looking into, is the price of a stock or bond. It's very difficult to predict how it's going to develop, but we have a very good idea of how it has moved during the many, for many, many years. Right, so we look into that data and try to learn from that. We put it into some sort of a scenario generator, and then out of that we get a scenario tree normally, which has the form of there's something called a lattice. It's a recombining tree, or it could be just an event tree where you have a non-recombining tree. But it would be some sort of a scenario tree, which then goes into an optimization model. So that's the process when you talk about scenario optimization that you looked at already last week, or stochastic programming. Starts with data, then some scenario generation. The end result is some sort of a stochastic scenario tree, which is used as an input in your optimization model. And you're going to work with that later today and for your final project as well. Right, so let's look at the example that we already talked about. That's on interest rates. So the question is, can we predict interest rates? The answer to that was already no. It's not really possible to predict how the interest rates are going to move. We can look at, probably you can hardly read this, but there are many factors which have an impact on interest rate, right? So obviously we have supply and demand. I mean, that's kind of one of the main drivers. That's one way of looking into the interest rates. I mean, supply and demand of what? Is it what kind of supply and demand has an impact on interest rates? On loans, money, right? Money market, right? So the supply and demand. So interest rate is kind of the price of money, right? The price of lending and borrowing money, right? So supply and demand, of course, is one of the main drivers. Then the central banks have an impact. They try to influence. And how do central banks try to influence interest rates? Right, by increasing or decreasing supply of money, right? So that's they can, in central banks on the supply side can have an impact. Then there is also a question of inflation has an impact. I mean, inflation can go both ways, but what is the usual case? I mean, when you talk about inflation, what happens if the inflation goes up? What happens with interest rate? Goes up as well, right? So obviously those are quite directly related. Then it's the question of what are the things which cause inflation? I mean, you probably have studied a little bit. What are the things? What causes inflation to go up? Well, it's too much money in the system can get the inflation, the money, it would essentially means the money would become become worthless. But yeah, that's one fact. But there is one more kind of fundamental. What is kind of, normally when we think of inflation, what is the main driver of inflation? Again, it's in terms of supply and demand. When does the price of there is more demand than there is supply, right? So that could be one. So there is, and that is in terms of economic output. What does it mean? That there is there in terms of consumption, for example, there is more consumption than there is production, right? So these are the cases that you would see in the cases like in countries which, let's say, there are boycotts, and you would normally see, say, inflation on goods. And that's not because of an extra supply of money. I mean, because you're thinking, I mean, in terms of cases of hyperinflation and so on, then if you're just printing a lot of money without backing on that, that would also cause inflation. But kind of normally when we think of the inflation, I mean, the more kind of economic reasoning behind inflation is that there is more consumption than there's production. So that's the usual case with inflation. But then again, it means that the price of money will go up because there would be people who are willing to pay more interest rates to borrow money to start means of kind of production, to produce more, to kind of live up to the consumption which is in the markets.
But why do we have negative interest rates then in Denmark now? Because the consumption is actually relatively high now compared to...
Yeah, well, that's a very good question. I mean, I discussed this shortly some weeks ago. So the question is, why is it that we can get negative interest rates? Because I mean, again, inflation is a very difficult. There are many different reasons to it, and just to make that a story short, I mean, the reason we have inflation currently in a country like Denmark, that we have this fixed exchange rates between Danish krona and euro, and that kind of has some side effects. And in this particular case means that you have the countries in the north which are more productive, and then you have the countries in the south which are less productive. And as a result of that, you'll see very high levels of interest rates in the south, because they are not kind of they are not productive enough. So as a result of that, if they were not in euro, but if they were in their local currencies, actually the value of their currencies, because of their lack of productivity, will fall. That's what happens when you have fluctuating currencies, right? So if you're less productive as a country, as a result of that, automatically you're less productive, you'll have less exports. And when you have less exports, then the value of your currency would drop. And that's kind of the normalizing mechanism in a way, right? So labor automatically becomes cheaper, and hopefully that means your production will go up again, and that kind of balances things out. The problem with having a fixed exchange rate mechanism without going all the way through, without having a so-called transfer union where actually the countries with surplus will actually pay the deficit of the countries with a deficit, which is not happening in Europe. We have common currency, but we don't have a transfer union, which we have in any country. Like if you consider Denmark, Copenhagen, Aarhus are kind of the richer areas. They have surplus. They will automatically pay their surplus. They pay more to areas like Lolland or the periphery, which is not doing quite well. Probably the same in Iceland. You have more productive places than others, and then you have some kind of transfer mechanism of cash. We don't have that in the Eurozone, and as a result of that, then you get these kinds of side effects, that the countries which have a surplus, I mean, their money should, the value of their money should go up, but they are in euro. And the countries which have deficit, the value of their money has to go down, but they are also in euro. So what happens? It's compensated in the level of interest rates instead, right? Because then that essentially means that you have to send less money to the north. But then again, people are, because of political uncertainty, they will, despite the fact that the interest rates are low, they're still sending money up north, because they don't want to keep, if you were a Greek businessman with billions of euro in your Greek account, or call it you have billions of Greek euros in your Greek account, you would probably want to put some of them in Danish krona or the German euro, in German bonds. So you're willing even to pay for your money to be in the safe havens rather than having them in in Greece where there is a risk of a Grexit, where in the case of Grexit, then overnight your money will be confiscated and turns back into drachma, right? So that's, and then loses value. So it's a long political discussion, and it's something we haven't seen before, but that's actually, that's also another reason why the level of interest rates, even in these days, even more difficult to predict, so even more so. Definitely you can't predict a level of interest rates, but you can just simply say interest rates change with time, and we don't know exactly how, but we can generate some scenarios over that. Right. So then let's look into some different ways of generating scenarios before we take a short break. All right. Then again, as we discussed, you can go from data to some scenarios, and you can either do that pretty directly by what is called bootstrapping, which I'm going to explain to you after the break, and you're going to work with during the exercise hour. So that's one way, directly bootstrapping, sampling data using the bootstrapping method, directly going to scenarios. That's slightly more kind of advanced than what you did last week, which was essentially just reusing historical data as scenarios. That's not really scenario generation. That was just getting it started. But when you want to do some kind of proper scenario generation, you have to do some kind of sampling, some kind of simulation, and that's what we're going to go today when we use bootstrapping. So you either do things like bootstrapping, directly sampling from data and generate some scenarios, or you can do something which is more advanced. So what that could be, it could be that you're looking into some statistical properties of data. There is a method called moment matching. I'm going to give you the links to that. Moment matching is a very popular way of scenario generation, where the idea essentially is that you look into historical data, you look into the statistical moments of historical data, and statistical moments, anybody knows what statistical moments are? The first 4 moments, let's say. The expected value, that's the first moment. Variance, or standard deviation. Third, fourth moment, anyone? It doesn't have to be in that order, just 2 more orders, statistical or moments. Have you heard of the term skewness? So skewness, there's also a moment, says something about whether your distribution is kind of distributed in equally to the left and right of the center, or there's a bias in one sense. So it says something about the bias of the distribution. That's a skewness. How biased is the distribution? And then the last one, the fourth one, is kurtosis, which says something about the thickness of the tails of the distribution. So you think of this statistical analysis for scenario generation. One method of that could be moment matching, where you look into these 4 moments and you look into the correlation among different assets if you have many assets on which you want to do scenario generations. And then you try to sample from those statistical moments. That could be one way of scenario generating, which is exactly what moment matching is about. You could also go even beyond that, and then you can have some stochastic processes. So probably some of you have taken a course or 2 in time series analysis and stochastic processes, where the whole idea of that is to look into historical data and try to fit that to some theoretical frameworks for trying to prescribe how some stochastic parameter is going to develop in the future. These are some descriptive models which are going to tell you something about the movement of a stochastic variable, and with all the uncertainty around that. And you can start with a stochastic process like that. Many of those stochastic processes, by the way, are the ones which are used in prediction modeling. So if you were using, for weather forecasting, for example, you would be very much interested into looking into stochastic processes, because then you can fit historical data on wind and on rain and what have you, and then you can actually get very precise predictions. So in the area of prediction, you would go normally in extreme length and do things like looking into very advanced stochastic processes that help you predict the direction of your stochastic variable. In terms of scenario generation, what you would do with them, you will then discretize them, and then you will sample from that to generate your scenarios. And then the question would be, if we are dealing with something which is anyway difficult to predict, why would we want to go through the hassle of looking into some very complex stochastic process model if at the end of the day we're going to simplify it and come back to just a bunch of scenarios that we want to use for our risk management? In many cases, actually, is not really worth, because we don't know enough. The extra value we get by making your model more complicated is valuable if you're talking about wind or rains, but in many cases, if you're thinking about direction of stocks and bonds, sometimes simple models are just as good, or maybe even better, when you test them out of sample. So that's why I'm going to work with a very simple model today, which is bootstrapping after the break. And then for later, of course, it could be the topic of a master thesis that you can actually take a simple method like bootstrapping, but you can also use a stochastic process and say, well, would that essentially mean that I get more performance out of a more complicated underlying method for scenario generation comparing to just simply bootstrapping historical data, right? So those are, and there are studies like that which are done. In some cases, you might get slightly better results, but I haven't seen personally many convincing results in that area either. So there is definitely space for research still. Right? So I think that is more or less what I wanted to say for now. So let's take a short break and start again 5 minutes to 2 or 3. So, no, 2, that is, yeah.